Hey, good morning, it's Owen Bigland. This is the Inside Edge video blog. Time for one of my Investing 101, the psychology that you need to have to create wealth video blogs here. I get a lot of requests for these and I enjoy doing these ones. I like to do 4 or 5 of these every year. So let's talk about, again, the psychology that you need to have if you want to create any type of wealth, financial security, retire, maybe retire early. If you want to do those things, then it's fairly straightforward. You're going to have to get comfortable with being a little bit uncomfortable, meaning that you're going to have to buy assets that can appreciate, whether it's real estate or stocks, antique cars, I don't know, but let's talk about real estate and equities or stocks. If you want your money to work for you and get a good return and start earning passive income, you've got to invest in these 2 areas. But unfortunately, prices of these are set by the market and they can fluctuate up and down wildly sometimes. So you have to get comfortable with some short-term fluctuations in the value of your holdings. If you're not comfortable with that, then I'm afraid to say that it is going to be very, very difficult for you to retire comfortably or create any type of wealth in this world. It goes with the territory. If you want the returns, you've got to be able to withstand some of the short-term volatility. But what I've always advocated on this blog from experience, I've been a stock investor for almost 28 years now and a real estate investor for close to 25 years. So I've got some experience. I've seen lots of good markets and bad markets. If you give it enough runway, buy it right, hold on to it, and don't get spooked by the short-term volatility, you're going to do absolutely fantastic. As Jack Bogle says, buy it, don't fiddle with it, the founder of Vanguard, and you're going to do tremendously. So it is late February 2016 here. Let's talk about 2 things that are going on right now as far as the stock market and the real estate market in Vancouver, because they are at complete opposite ends of the spectrum here. So let's talk about, and the reason I want to talk about this is because I'll get a lot of people that will email me. People call me, they phone me, they comment on my YouTube blog, and they'll say, Owen, you know, you have a lot of conviction in what you're saying, and that's one of the things that that comes across, I guess, when I do these video blogs, when I talk about investing. And they often ask me, well, how do you have so much conviction in this? I mean, you know, you tell people to buy a stock, hang on to it. If it drops 30 or 40%, buy more. Use it as a buying opportunity. Or you tell people, you know, buy real estate even in this absolute peak record high price market we're in right now. And don't worry if the price goes down 20% 3 years from now. And people have a hard time with it. I can understand it. They say, I bought that house for $500,000. And if in 3 years from now, if it goes down to $460,000, I'm going to be panicked. And I tell them not to be panicked. Just to ride it out and let it recover. You need a roof over your head. Don't look at your principal residence purely as an investment. Look at it as shelter first. Give it enough runway and time, and you are going to do tremendous on it as far as capital gains go over the long term. So, as I speak right now, why I have so much conviction? Well, first off, I've been through lots of markets. As I say, I've been investing in the stock market for over 28 years now. I've seen my stocks soar and I've seen them plummet. But I never get worried about it. As a matter of fact, when the good stocks that I own that are valued properly, when they go on sale and the prices are down like they are now, I buy more if I've got the available cash to do it. So let's talk about conviction first off in the stock market. So as I speak, the S&P 500, the TSX, the Dow are all at 52-week lows. I've got stocks trading right now at 2- and 3-year lows. They've been beat up pretty bad. My portfolio just so far this year is down probably about 18%. It's been pretty beaten up. Now, I only buy companies that, first off, I've talked about it before, pay a solid dividend. So these are dividend growers, companies with good, strong balance sheets, good cash flow. Give you an example, Johnson & Johnson. So Johnson & Johnson right now, core holding for me, it's trading at a 52-week low. I just finished buying some Johnson & Johnson earlier this week. I'll probably buy some more and average into it at these prices, depending on what the market does here. But I'm not worried at all that my shares in Johnson & Johnson have gone down 15% here in the last couple of months. I look at it as a buying opportunity. It's paying me a 3.5% dividend yield every year. And I always ask myself, with the companies that I buy and the companies that are core holdings for me that I hold forever and pay me these dividends, I always ask myself, if I'm going to buy some more shares in Johnson & Johnson tomorrow, what do I see the future as for Johnson & Johnson? In other words, do I still see a company like Johnson & Johnson being relevant 5, 10, 15, 20 years from now, still making money, still selling product, and still paying me a nice dividend and an increasing dividend stream every year? So are they still going to sell pharmaceuticals? Do they still have a pipeline of new drugs that are coming out? Are they going to still sell medical devices to hospitals and medical clinics? Are they still going to sell consumer products like Listerine and Band-Aids and Tylenol? And I look at the company and the answer is yes. It has, for the last 70 or 80 years, continued to grow these businesses. They've got what we call a wide competitive moat. Very difficult for other companies to break into the consumer products that Johnson & Johnson is dominant in. The same can be said for companies like Procter & Gamble, Eli Lilly, Pepsi, Coca-Cola, Walmart. These companies are really cash flow machines. They're incredibly profitable, so profitable in fact, that they not only make enough money to pay all the expenses to run the company and pay the employees and save some money for further research and development and for more acquisitions, but they also pay out a nice chunk of change every year to the shareholders for holding the shares. So that's the way I look at it with a stock. The company that I own, do I see them still continuing to make money down the road? And if you don't, then that's probably not a company you should be investing in. You know, an example would maybe be Tesla. Tesla makes a fantastic car from what I hear, but they're not making any money. The stock is valued at a very high multiple, very risky. Everything has to go perfect for a company like that to make money on it down the road. Whereas a company like Johnson & Johnson is trading at a very low multiple, spins off lots of cash flow, and pays a healthy dividend. And I can see that the company growing just like it has for the last 60 years. It's a sleep at night stock. So what I'll do before on this blog, I will post an article on a profile that the Globe and Mail did on me. The Globe and Mail, if you're outside Canada, is our version of the Wall Street Journal. It's our national business newspaper. So I'll post a link to a profile that the Globe and Mail did on me on a little bit more detail on my investing philosophy, the type of stocks that I own, and a snapshot of my portfolio. I think you'll find it interesting. So now let's go back to real estate. As I say, the S&P 500, the stock markets are at 52-week lows. The Vancouver real estate market, the beast known as the Vancouver real estate market, is at all-time highs right now. Whatever you buy, if it's a condo in Yaletown or a detached home in East Vancouver, you are paying absolute peak price for this. And I've gone on lots of blogs on what the cause and what the catalysts are for why we've got these prices. Interest rates is the big thing. But I'll get people that will comment on my blog saying, Owen, how can you recommend with such conviction that a young person buy a condo today in Yaletown for $480,000 and not be worried that the price of that condo might go down 5 years from now and it might only be worth $425,000? And yeah, that might happen. There's actually not a bad chance that will happen. The markets don't go up forever. We've been on a 3-year roll here. It might go on for another year or two, and then yeah, we might get a 20 or 25% correction. There's lots of things that can happen in the short term. But I've always said in my blog here, you buy a piece of property for the long term, 8 to 10 years minimum. Anything after that, if you can keep it, you are going to do fantastic. But if you phone me up and said, oh, I want to buy a condo and I might have to move to Montreal in 2 years, I would say just stay renting. You don't have enough runway there. But people will say, why do you have so much conviction in real estate? And I'll tell you, the reason is that because I've been through these ups and downs over the last 25 years. Markets always recover. We're going to eventually get a bit of a correction or a leveling off eventually down the road here. But it will recover because I ask myself the same way I buy a stock. What do I see the future demand looking like for living in Vancouver? Do I still see people 15, 20 years down the road wanting to live in neighborhoods like Kitsilano and Yaletown and Cole Harbour and Mount Pleasant and False Creek? If the answer is yes, then you buy it, hang on to it for 8 years or more, the value is going to go up. If you think, I think Vancouver's not going to be as desirable of a city down the road, then hey, maybe you should just stay renting then. From my perspective, I see Vancouver being a much more desirable city as we move along. As a matter of fact, I'm going to say that the price that you can buy an older Mount Pleasant condo for right now is going to seem like a bargain 10 years from now. It will. They're not making any more of it. We don't have a lot more buildable land. Demand is continuing to increase every year. We're always going to have, in the short term, some volatility. In the long term, though, Vancouver is going to be an incredibly desirable city to live in. The world has discovered Vancouver, as we all know. We're not competing anymore with local buyers for that Yaletown condo. You're competing against buyers from Southern California, Washington State, other parts of Canada, China, the Middle East. All over the world, people want a piece of Vancouver. And I know a lot of people will complain, we've sold the city out. What's going on in Vancouver right now is going on in every good world city right now. From Vancouver, all down the West Coast, Portland, Seattle, San Francisco, Southern California, San Diego, Miami, New York, Toronto, Chicago, London, all the cities that are desirable places to live. You're not just competing with locals anymore. And I see that continuing with Vancouver down the road. As I say, you can buy an older Mount Pleasant condo, wood frame in the high threes right now. I think in 10 or 15 years, people are going to look back on that and say it was a bargain. Now, 5 years from now, the price of that $300,000 or $400,000 condo might go down 5 or 10%, but it will recover because the desirability to live in Vancouver is there, and we just can't create enough new product to fill the increasing demand every year. People want to live in Vancouver. This is one of the best cities in the world to live, bar none. Best city in Canada to live, bar none. This is where people want to live. Back east, they retire from Toronto, Montreal. If they've got a bit of money, this is where they're going to want to live and retire. So that's why I have so much conviction. I've been through lots of ups and downs, both in the stock market and the real estate market. I look at it from the perspective, what do I see 10, 15, 20 years down the road for the either real estate, the desirability to live in Vancouver and wanting to live in a city like Vancouver. Same thing with the stocks that I buy. Do I still see this company being relevant 10 or 15 years down the road, continuing to sell products, continuing to make good profits and strong cash flow? And that's how I buy the stocks that I own as well. So I'll post a link to my article, a profile they did me on Globe and Mail. I think you might find it interesting, give you a little bit more perspective on where I come from as an investor, and a good starting point if you wanted to do some of your own investing. It has a link to my portfolio there. I'm Owen Bigland. I dragged on a bit here, but hey, I hope you learned something. You can always reach me, Owen at owenbigland.com. Thanks for watching. I'll see you next time.